Let's talk more about these stress tests. Bring in Bruce Harding from Wedbush, Chuck Lieberman from Advisors Capital Management. Bruce, this is 23 banks. There are a lot more regional banks than that. I'm not sure if there was any surprise that they all passed. Should investors take any solace from this, or are there really still questions among the smaller banks that might have significant amounts of commercial real estate in their portfolios?
Sure. Thanks for bringing me on today. Good to see you. I think these results are great. The banking industry still has a number of hurdles they have to overcome in the next few months and the remainder of this year. You know, on your show this morning, we heard.
Yeah, we're having a little trouble with
Chairman Powell talking about to see if we get one or two more tightenings. Now, the good news about that is, for the most part, the long end of the curve, 5 out to 10 years have been pretty stable, and that's what impacts the held-to-maturity portfolios that have given some of the banks problems in terms of their lower-yielding securities portfolios. But the continued rise in short rates will continue to push up and put pressure on the funding costs of the banks. So that's one thing that I think is keeping investors away for all the banks, even the ones that have passed here. And the other wait and see is, as Leslie pointed out, will we have more regulatory reform? Now, I think also Chairman Powell has said that if any major regulatory changes happen, they'll likely be phased in over a number of years. But that's another thing keeping investors who may have gotten burned holding some of the banks that failed earlier in the year from jumping back in.
Chuck, the overall environment and what, if anything, these specific results do to shed light on that? We're still expecting consolidation among the regionals?
Yeah, I think clearly the regionals are going to be under pressure to consolidate. I agree that there will be more regulations coming, and they're going to be aimed, at least initially, at the tier right below the systemically important banks, the large regionals and the smaller regionals. Those are the banks where, shall we say, the regulatory oversight has been a little bit lax. The majors have regulators in there every single day. And these tests were really aimed at the larger banks. So those companies are in good shape. And one of the interesting aspects of it is even with $100 billion in commercial losses, which is one of the concerns in the market today, those banks will pass and pass obviously pretty easily. So one of the market's concerns about commercial office space, I think, is a little bit less critical today. But it's the regionals where you really have to worry, and there is going to be more regulation. But fortunately, the Fed recognizes that. And so the changes are likely to be implemented very gradually over time and pushed out into the future so they don't disrupt things now.
Yeah, Bruce, I am going to pick up on that thread around commercial real estate and those implied losses that resulted from these tests as well, and get your thoughts on whether that number sounds manageable to you, $100 billion, or in line with what you would have expected, or better or worse?
Morgan, it's in line with what we would expect. Last year's results were quite similar. I was surprised that the number wasn't, considerably changed or higher. And I think for the most part, given that the stress tests that we just went through, the smaller banks do have to do their own stress test analysis and turn that in every year. And they show similar results on the commercial real estate side. So, we feel pretty comfortable that as much as this is, sort of topic number one in terms of potential recession impacting commercial real estate, that the banks have ample capital to offset that.